All right, let's jump right in. Today we're looking at Lumentum, a stock that has been on an absolutely wild ride. Just yesterday, it hit a major speed bump. So what we're going to do is break down why it dropped. And then we'll explore a really fascinating strategy for how you might actually trade this exact kind of volatility. So yeah, here's the headline number that caught everyone's eye. Yesterday, Lumentum stock, that's ticker LITE, took a nosedive. We're talking a sharp 6.6% drop. A single-day drop like that always turns heads, especially when you see where this stock has been lately. And what a run it was. I'm not kidding, before this plunge yesterday, the stock had surged, get this, over 1,000% from its 52-week lows. I mean, think about that. 1,000% gain, then a nearly 7% drop in a single day. That right there is the very definition of extreme volatility. And that's really the key to understanding everything that happened next. So the crucial question is, why now, right? After a meteoric rise like that, what made the floor suddenly give way? Well, it turns out it wasn't just one thing. It was more like a perfect storm. We've actually pinpointed 4 key factors that all came together to trigger this sell-off. So let's break them down one by one. So, like I said, a perfect storm. You got your classic sell the news event, a valuation check that was, let's be honest, probably overdue, some real concerns about future spending, and then just the general pull of the broader market. Let's kick things off with that first one. All right, first up, we have the classic sell the news effect. See, the company announced its earnings date is coming up on May 5th. And for traders who'd been riding that 1,000% wave up, that date suddenly feels like a finish line. You start thinking, why would I risk a bad earnings report when I could lock in these massive profits right now? And well, a lot of them decided it was the perfect time to cash out. Second, the numbers were just getting, well, stretched. Lumentum was trading at a price-to-earnings ratio of 236. Now, just to put that in perspective, that is incredibly high. It basically means investors were paying a huge premium for its earnings, a price that's just really hard to sustain, you know? And when you get to those stratospheric levels, the big institutional investors, they get nervous. They start rotating their money out of these parabolic winners and into tech stocks that look a little more, shall we say, reasonably priced. It's like a much-needed valuation cooldown. Okay, number 3, and this one's more of a forward-looking concern. Lumentum is in the middle of a massive expansion. We're talking a $3.8 billion factory plan. Now, while that sounds great for long-term growth, right, the market is looking at the short-term cost. I mean, spending that much cash can lead to a deficit in free cash flow. That's the actual money a company has left over. It's a classic scenario. They call it the capex trap, and it definitely made some investors pretty cautious. And finally, let's be real, Lumentum didn't fall in a vacuum. The entire NASDAQ index was down about 1% yesterday. There's just this wider risk-off feeling in the market right now, especially for these high-growth, high-multiple tech stocks. You know the saying, a rising tide lifts all boats. Well, the opposite is also true. When the tide goes out, even the strongest swimmers can get pulled down with it. All right, so we get the why now, right? The stock is being pulled in all these different directions, and that's creating a lot of fear and uncertainty. Now, for most people, that's a big red flag, a signal to stay away. But for a certain type of trader, that fear, that's the opportunity. So the question becomes, how could you actually trade this volatility? And this brings us to a really cool strategy. It's called the volatility harvest. And the idea here is actually pretty simple. Instead of trying to guess which way the stock will go next, up or down, you can actually make money from the high level of uncertainty itself. You're essentially selling that fear to other traders in the options market. Now, the specific tool we use for this is called a bull-put spread. And I know, the name sounds intimidating, but don't let it fool you. The concept is really straightforward. So it's an option strategy where you actually get paid cash right up front. And here's the kicker. Your bet isn't that the stock will go up. Nope. Your bet is simply that it will stay above a certain price by a specific date. Think about that. That means you can make money if it goes up, if it stays flat, or even if it drops a little bit. You're just betting on a price floor. Okay, so theory is great, but what would this actually look like for Lumentum? Let's walk through the exact mechanics of setting up this trade. It's actually just 3 simple steps. Okay, step 1, you pick the expiration date. In this case, we're looking at May 15th. And what's really important here is that this is after their earnings report. Step 2, you sell the 700 put option. This is the heart of your bet, right? You're saying, I think Lumentum will stay above $700. And then step 3, you buy the 680 put option. This is your safety net, your insurance. It defines and caps your maximum potential loss right from the very beginning. So let's just lay it all out right here. The strategy is a bull put spread. The expiration is May 15th. We're selling the $700 strike and we're buying the $680 strike for protection. At the end of the day, our one and only goal, the only thing that matters, is for Lumentum to close above $700 on that expiration date. That's it. Okay, but let's be clear about something. No strategy is risk-free. So we have to look at the balance here, the risk versus the reward. What makes this particular play so compelling right now? And what's the potential downside? Let's really dig in. Well, there are really 4 key reasons this setup looks pretty compelling. First off, you've got a safety margin of 11%. The price has to drop quite a bit just to hit your target. Second, because of all that fear in the market we talked about, you get to collect a really high premium. That's the cash in your pocket. Third, if you look at the charts, there's a strong technical support level for the stock right around $688. And finally, and this is a big one, time is actually on your side. With this kind of strategy, every single day that ticks by, the options you sold lose a little bit of value, and that's called time decay, and it's a direct profit for you. So here's the trade-off, plain and simple. The reward? You get to keep the entire chunk of cash, the premium, that you collected up front, as long as Lumentum stays above $700. The risk? Well, if the stock totally collapses and goes below 680, you will have a loss. But, and this is so important, that loss is capped. It's defined from the moment you put on the trade. There are no surprises. And on top of all that, there are a few other things that could act as a kind of safety net here. I mean, Lumentum has a huge partnership with NVIDIA, and they were just recently added to the S&P 500 index. Now, what does that mean? It means that large institutional funds, the dip buyers, they might see any big drop as a buying opportunity and step in to defend the stock, especially around that really critical $680 to $700 level. And that really brings us to the final question, doesn't it? We're all taught that volatility is pure risk. It's scary, it's something to run away from. But as this whole Lumentum situation shows us, that very same volatility can be the source of incredible opportunity, if you have the right strategy. So it makes you think, in today's market, is volatility the risk you should be avoiding, or is it the opportunity you should be harvesting?